Hey everyone, welcome back to Intermediate Financial Accounting 1. In this class, we are going to talk about balance sheet and statement of cash flows. So first of all, balance sheet. What does balance sheet report? Balance sheet report a company's assets, liabilities, and shareholders' equity at a specific date. So different from the income statement, which is a flow statement, balance sheet is a firm's financial position at a specific date. So there are three balance sheet elements: assets, liabilities, and shareholders' equity. Assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. So it represents future economic benefits. Liabilities are probable future sacrifice of economic benefits arising from present obligations of an entity to transfer assets or provide service to another entity in the future as a result of past transactions or events. And shareholders' equity is a residual interest in the assets of an entity that remain after deducting its liability. So in other words, shareholders' equity is assets minus liabilities. So first, let's look at asset. There are two kinds of asset: current asset and long-term asset, which is also called non-current asset. So what is current asset? Current asset are assets expected to be converted to cash within 1 year or one operating cycle, whichever is longer. What do we mean by operating cycle? So let me give you an example. Suppose I have a bakery and I make cupcake and sell cupcake in my bakery. So what do I need to do in order to make and sell cupcakes? I need to first use cash to purchase those raw materials. For example, I need to use cash to purchase flour, to purchase sugar. So that is the first step. Use cash, for example, to buy flour. And then after I get those raw materials, what else do I need to do? So I use those raw materials to make cupcake. And after that, after I have made those cupcake, I need to sell those cupcake. So this is the process of my business, right? And then after I have sold those cupcake, what can I get? I get cash back. So from the first step of using cash to purchase raw material until I sell my finished good to get cash back, this whole cycle is called one operating cycle. And the specific asset that can usually be converted to cash within 1 year or one operating cycle, including those. So cash and cash equivalents, that is the most liquid asset the firm has. Short-term investment, account receivable, inventories, prepaid expense. So those are usually the assets that is the most liquid of the firm that is expected to be converted to cash within 1 year or one operating cycle, and those are usually classified as current asset. And for non-current asset, we usually have long-term investment, PP&E, intangibles, and other long-term assets. So those are the some typical asset items. And for liabilities, similarly, liabilities, we have current liability and long-term liabilities. Current liabilities are obligations expected to be satisfied through the use of current assets or the creation of other current liabilities within 1 year or one operating cycle, whichever is longer. And the usual items for that can be included, classified as current liabilities are short-term note payable, account payable, unearned revenue, accrued liabilities, current maturity of a long-term debt. So those are the usual items of current liability. And long-term liabilities, so sometimes long-term liabilities sometimes include items like long-term debt. So those are typical long-term liabilities. And shareholders' equity include common stock, additional paid-in capital retained earnings, accumulated as a comprehensive income, treasury stock, and non-controlling interest. So after we have gone through the items usually included as assets, liabilities, and shareholders' equity, now let's look at, so I'm going to show you two ways to make a balance sheet. And please tell me what is wrong with either of the way. So the first example is if I make balance sheet this way. So I have, for example, assets 100, liabilities 50, shareholders' equities 50, and that's it. So this is one example of making a balance sheet. Another example is if I have a balance sheet, and here is how I do my balance sheet. So I have cash from, for example, the owner 50. I have cash from borrowing 50. I have cash from sales 50. I have accounts receivable from person A 50. I have account receivable from person B 50, and then it can go on and on. Could you take 5 minutes? Please look at these two ways of making balance sheet. And can you tell me what is wrong with either of those ways? You can pause your video for now and think for a bit. So what is wrong with the first way of making a balance sheet? That is too simple, right? There's not enough information here. So if I'm a firm, I just make my balance sheet this way, my asset 100, liabilities 50, shareholders equity 50, that's it. Is this balance sheet useful for investors? Probably not, right? That's too simple, not enough information. And how about the second way of making a balance sheet? There's too much information in this balance sheet. So as an investor, I only need to know that your firm has cash 150. Do I need to know where this cash is from? I probably doesn't need to know that, right? Whether it's cash from the owner, cash from borrowing, cash from sales, it's all identical cash that I put in my bank. So it doesn't really matter for investors that much for knowing where that cash is from. The same with account receivable. So no matter whether it's from person A, person B, person C, it's just all account receivable for me. So providing too detailed information can also be, for an investor, can also be too overwhelming, which makes this information not that useful. So the second way of disclosing information may not be useful for investors neither, because it may overwhelm investors that they cannot pay attention to the really important information. So in order to improve the usefulness of financial information, what we do is we separate items with different characteristics and group items with similar characteristics. So in other words, for those items with similar characteristics, for example, they are all cash, we group them together. We just report 150. However, for cash and account receivable, those are different those are items with different characteristics. So we need to separate those. Instead of grouping all of those together and just report cash. And just report asset. So this is what we do when reporting those balance sheet items. So specifically, classification of elements on the balance sheet. On the balance sheet, we classify it according to liquidity. We classify them and arrange them according to the liquidity of those assets. So for example, the left-hand side of the balance sheet is asset, and current asset is usually the most liquid ones. And then long-term investment, PP&E, intangible. So those are arranged according to the liquidity of the asset. On the right-hand side, we have liabilities and shareholders' equity. Liabilities are usually arranged. So the way the sequence of those balance sheet items, usually they are arranged according to the liquidity. And now let's look at an exercise here. So I have a lot of items here. Please take 5 minutes. Try to arrange them into a balance sheet format. In other words, so those items, those are all balance sheet items. And I want you to put them in the format of a balance sheet. You can pause your video for now. So let's look at this balance sheet. This is actually an example taken from Starbucks real balance sheet. So as you can see here that we have assets and current assets first. So within current asset, we first have cash and cash equivalent, which is usually the most liquid asset of a firm. And then short-term investment. So both are available for sales securities and trading securities. Those are short-term investment. Those can be short-term investment. And then account receivable, inventories, prepaid expense, and current asset, deferred income tax. So for deferred income tax, it can both be short-term and long-term, and it can both be asset and liability. And then after we finish the current asset, we go to long-term investment, and available for sale security can also be long-term. Equity and cost investment. So that's another kind of investment. PP&E as an asset, as an intangible asset, and goodwill. What is goodwill? We're going to talk about it when we talk about intangibles. And then after we finish the asset, then liabilities and equity. In this right-hand side of our balance sheet, we begin with the current liability, including account payable, and then accrued compensation and related costs, accrued occupancy costs, accrued tax, insurance reserves, other accrued liabilities, deferred revenue. So those are usually current liabilities. And then after current liability, we go to long-term debt, which is a long-term liability, other long-term liabilities. And this finished the liability section. And then after that, we have shareholders' equity, which includes common stock, additional paid-in capital, other additional paid-in capital, retained earning, accumulative other comprehensive income, and then non-controlling interest. So this is the way to arrange a balance sheet.